Hello, this is Tim Congdon. I'm chairman of the Institute of International Monetary Research. This is the latest monthly update of trends in money and banking and how they affect the world economy. I'm speaking in November 2017, but I'm going to be looking back over a decade. Earlier this month, the Institute had a conference in London on the theme, Has Financial Regulation Gone Too Far? It was an interesting conference for the debate, really, between those who felt that one aspect of financial regulation, namely banks' capital requirements, so-called macroprudential regulation, had become excessive and over the top, and others who felt that it's important to continue with recent trends. I probably don't need to tell you that the decade since the great financial crisis has been characterized by a relentless demand from international officialdom, regulatory officialdom, for banks to have ever more capital relative to the risks they take in their business. This has been motivated by a view that the reason for the Great Recession was that banks went bust, and therefore this must happen again, and in future they must always have some spare capital to help with their business, their lending, for example, if they get into trouble. I'm going to question that view in my presentation today, and I'm going to cite lots of facts and figures. I'm going to focus on Britain rather than America this time, and I want really to look at the impact of the rise in banks' capital ratios, this huge drive for bank recapitalisation, on the composition and the level of UK banks' assets. Now, I'm going to start, as there's lots and lots of figures, so I'll be referring to my notes frequently, and I hope that doesn't put you off, but I have to do that. One of the key issues in all of this is, did British banks at the start of the crisis have too little capital? Obviously, the demands for extra capital would make sense if at the start they had too little. And that means too little relative to the losses that they had in the crisis period. Let's just get some numbers out. Let me just say straight away that the banking website has a wonderful database, all sorts of series, thousands and thousands of series, millions and billions of numbers. And it's often very difficult to find the number you really want. And I have to say that in the case of something as central, something as basic as the UK banking system's equity capital, that indeed is a problem. Despite all the problems, it is in fact possible to find a figure for UK banks' capital in the Bank of England website. And the figure, to be precise, is, well, it's a series mnemonic RPMB3JN, for heaven's sake. And it doesn't go back before 2010, but it says that at the start of 2010, the sterling capital of UK resident monetary financial institutions at banks, excluding the Bank of England, was £486.2 billion. Now, it's not the same figure as the figure at the end of 2006 or end of 2007, just before the crisis. And the sterling capital is not the same thing as equity capital. It's not properly risk-bearing, but it gives you some sense of magnitudes. All right. Now, there's a separate source. This is something called Company Refs, which actually has all of the profits and losses accounts and so on of all British companies prepared for stock exchange investors. And this does have figures for all of the large UK banks, large quoted UK banks. I'm going to focus on the 4 or 5 banks quoted in the UK market that have UK operations. They include HSBC, which of course is a large nation bank. But anyway, these banks at the end of 2006, Lloyds, Barclays and so on, they had shareholders' funds of £143.3 billion. At the end of 2007, of £174.2 billion. Now, it's obviously much less than the 486 billion pounds I gave you before. The 486 includes much smaller banks, it includes non-equity capital, and there'd been quite a big change between 2006 and 2010. Anyway, I think a fair comment here is that the equity capital, the risk-bearing capital of the main British banks, the high street banks, was something of the order of £200 billion, perhaps a bit more, as the crisis broke. Okay. It's a reasonable sort of summary of the information I've just given you. Now, I should just say here that some of this information is in this book that came out from the Institute. It's in table to chapter 5. Anyway, there we are. Very, very detailed information. And that table shows that the losses of those banks that had losses, let's be clear, some banks had no losses, in the 6 years from 2008, the year of the crisis, totaled £34.4 billion. Okay, so the capital at the start was 200-ish. The losses in the crisis period were about 30-ish. That's roughly what happened on this criterion. Okay. Now, actually, the Bank of England does have information in its website about profits and losses, not on the same basis the company refs information. Let's compare them. Here it is. Here's the picture. I know you can't read it in detail. It's got a very detailed numbers. Here we are, B5RL, B5RM, and so on. I'm not making these numbers up. Okay. Now, according to the Bank of England, if the losses were only in 2 years, they were in 2008 and 2009. They were somewhat different bases from the company refs numbers. And what did they total? They totaled £31 billion. Okay. The figures are roughly the same. Okay. So we've got two sources suggesting the losses of the British banking system in this difficult period were about 30 billion, compared with initial capital of about 200. I put it to you, the initial capital was adequate. Now, I don't deny that one bank, HBOS, was completely bust and had to be sorted out. This happened in previous crises without having going through something like the Great Recession. And I don't dispute that banks in the crisis period had difficulties funding their business. And one of the key issues raised by the whole crisis is, was the best way of dealing with the bank's funding problems to force them to raise much more capital, which is actually what happened, or would it have been better to have extended large credit facilities from the Bank of England, from the central bank, as was done in the Eurozone by Mario Draghi when the Eurozone banks had the same kind of problem through 2011, 12 and 13. Okay, that is, to me, therefore, the overriding issue here is, was there any need to raise the bank's capital asset ratios from October 2008? Process has now been going on for the best part of a decade under the auspices of the Financial Stability Board, backed by the Bank for International Settlements, supported by the IMF, ultimately depending upon the authority of the G20 industrial nations. And anyway, whether it was right or wrong is what's happened. And what we now need to do is really to think about the consequences of this dramatic change in public policy for the assets of Britain's banks. And what I want to, first of all, make clear is that the banks did do what they were told. They were told to have much more capital. They did have much more capital. Again, this is company refs. Their capital at the end of 2006 was £143.3 billion. The capital at the end of 2014, 8 years later, the 8 years in a sense of the crisis and the recapitalisation and so on, was £287.9 billion. They doubled their capital. All right. Also in this period, of course, Lloyds took over HBOS and the RBS took government capital and became largely nationalised, and so on. Now, what's been the effect of this dramatic change in capital position enforced by the government, enforced by the international regulators on UK banks and their customers, because their customers matter too? What this chart shows you is the composition of UK banks' assets going back to the early 1990s. It shows you the split between the bank's claims on the private sector, mostly loans to the private sector, of course, and claims on the government. Now, UK banks also had claims on the overseas sector. My time is limited. Essentially what happened there was the UK banks' claims on the foreign sector, mostly foreign banks, fell very heavily after 2008, which was part of the adjustment to the bank capital requirements, but also, of course, to increase suspicion between banks in different nations about their solvency. Let's put that to one side. What you can see here is that until 2008, 2009, banks' claims on the private sector, lending to the private sector mostly, was rising relentlessly, remorselessly. Okay. Then it peaks and turns down, just at the end turning up again. In the first 15, 16, 17, 18 years of this period, UK banks had hardly any claims on the British government. Okay? The banks served the private sector above all. Okay? This is not like 1940, 1950, 1960, when it was true that British banks' assets were dominated by claims on the state. No, in this early part of this period, loans to the private sector were by far the most important kind of asset they had. Anyway, since 2009, claims on the government have increased spectacularly. You can see that red line at the bottom. That is the effect of quantitative easing. You see, the demands for banking system capital forced the banks to reduce their risky assets, their loans to the private sector, which would have hit the amount of money in the economy, which then was a massive deflationary shock to the economy that had to be offset by money creation by quantitative easing. And that's what that red line shows. So in the period up to from 19 years to the first quarter of 2009, lending private sector typically going by about 8.5% a year, then started to go down. And the claims on the state, which had been negligible in the middle of 2008, went up to £650 billion at the beginning of 2017 and are still around about that sort of figure. Okay, so we then have this question of, we've seen this drop in UK banks' claims on the private sector, then where did this hit? Okay. Did it hit companies? Did it hit individuals? Did it hit financial institutions? Which part of the economy is the most affected by this radical change in the composition of bank assets? It's a period when very often we've had politicians saying that banks should lend more to small businesses. Okay. I should just say before I go on that, as ever, these series are difficult to read. I have to look at different series. There are series breaks, there are reclassifications, there are redefinitions. It's a mess. But I'm saying it's all given in good faith. Looked at, without going into the detail, the peak figure for UK bank lending to the private sector was in fact in the first quarter of 2010. And since then, the claims have fallen by about a quarter in real terms in total. That's the whole economy, all private sector taken all together. But there's a complication in all this, which is that in the first few quarters of the financial crisis, the banks were in such a muddle. They had been cheating on their capital ratios by pushing business through some called special purpose vehicles, putting mortgage assets into that, and then not, because these were sort of not strictly speaking bank type organizations, not requiring capital, this reduced the amount of capital they needed overall for this sort of business. When the crisis hit, they had to go and put some of their business back onto their own balance sheets because these organizations couldn't fund themselves. I'm not saying the banks were saints and angels at all. But the result of this artificial move back of business towards the banks was to inflate the growth of lending to the private sector in the first few quarters of the crisis. If we take that out, the peak figure for lending to the private sector was in fact in the second quarter 2008, just as you'd expect, before the bank recapitalisation began. On that basis, then the fall in lending to the private sector from the second quarter of 2008 carried on until the second quarter of 2015, went on for 7 years, now seems to have stopped, was of the order of 30% in real terms. A drop of a third, almost, in real terms. Despite everything, this has in fact been a period of rising national output. So relative to national income, if we compare the second quarter of 2008 with 2015, the ratio of lending to the private sector, banking in the private sector to GDP, has fallen by about a third. Okay. There's no doubt this was caused by the recapitalisation process and the demands for higher banking system capital, because, as I've just said, banks have in fact doubled their capital since the end of 2006. Banks lend to households for mortgages. The system of regulation now in force, it comes from the Bank for International Settlements in Basel, Basel III, gives a low capital weighting for mortgages. Mortgages are regarded as very safe and therefore as not justifying a high capital demand. And as you might expect, lending to households has therefore been quite resilient. It has fallen a bit since the peak back in the second quarter of 2008, but not very much. In real terms, at most it fell by about 10%. Okay, so you've got it that the total fell for the nation as a whole by about a third relative to GDP, 30% in real terms, and lending to households, mostly for mortgages, fell by about 8-10%, that kind of number. By implication, the fall for other kinds of borrowers was much larger. Okay. Now this chart, I've put in the really bad boys, the financial institutions. They include these special purpose vehicles, also called intermediate other financial corporations, quasi-banks effectively. And you can see this surge in 2008-2009 as the business came back onto the main bank's balance sheets, and then a collapse. Okay. So that the financial institution-led financials fell from 700 billion to about 350 billion, now rising again a bit, fell by a half in money terms, fell by even more in real terms. The blue line is lending to mainstream companies, industrial commercial companies, both large companies, small companies. And that blue line is, if you like, much more where you'd expect, ideally, that that this figure is quite buoyant because this is mainstream business, isn't it? Well, the Bank of England started to get worried about this topic in 2011, very quietly, didn't say much about it in public, but still. And they do in fact compile two series for lending to large businesses and lending to SMEs. This starts in 2011, second quarter 2011. It doesn't include the worst of the collapse from Q2 2008 to Q2 2011, but you can see that since the start of this series, lending to small and medium-sized enterprises has been falling steadily. Okay? Lending to large businesses also going down, but now starting to rise again. Roughly speaking, lending to the UK private sector, including the financial sectors, dropped in 6-7 years up to middle of 2015 by about 45%, real terms. And then we have one particular series, I'm not going to go to the mnemonic again, for lending to very small businesses, unincorporated businesses, and they have in fact halved since the introduction of bank regulation. Okay, so let's just bring all this together. I don't think there's anything particularly surprising about what I've said. I'm sorry it's been rather complicated, but I've had to summarize a huge mass of data. The 60 years to 2008, the main driver of the growth in bank balance sheets and so in the quantity of money was UK banks increased lending to the private sector. Typically, lending to the private sector was growing in this period almost double-digit annual rates, much faster than nominal GDP, and also, of course, of real GDP. When bank regulation changed in the middle of 2008, the process went into reverse. If there hadn't been quantitative easing, there'd have been severe deflation, another Great Depression in 2009-2010. Practice, there was quantitative easing, so that the UK banks' claims on the state rose to about £650 billion in early 2017. There's been a big fall, about a third relative to GDP, since 2008 in UK banks' claims on the private sector. This hasn't really been in safe areas of lending like mortgages. It's been predominantly, most dramatically, in lending to companies, and then, to generalize, lending to the financial sector has fallen more than lending to mainstream companies, industrial commercial companies, and lending to small companies has fallen much more than lending to large companies. And that is the overall result of the bank recapitalisation exercise since 2008. Good or bad? Well, it's possible that in the middle of 2008, loans to the private sector were too high. It's possible that British banks were taking too many risks in their loans to small companies. It's possible. But that isn't what the political rhetoric of the last decade has indicated. On the contrary, all through this period, politicians have said they want banks to lend more to small companies, apparently unaware that the policy they themselves have been endorsing actually has led to a collapse in lending to small companies. I think it's very unclear that the bank recapitalisation drive that's been in place now for almost a decade has been well designed and appropriate. It certainly, in my view, was the main cause of the severity of the Great Recession in 2009. In my view, it's doing long-run structural damage to our economy, as it is almost certainly to other economies that are subject to the Basel rules as well. Thank you.